Hello, my name is Stephen Gamble and I'm the host of the Real Worth Stocks podcast. Real Worth Stocks is an investing newsletter on Substack, and we have 10 stock picks per year for our members. Our recommendations that stocks that we pick are bought for a real money portfolio, and the members get real-time buy and sell alerts when I buy and sell stocks for the portfolio. Today we're going to be looking at one of our portfolio holdings, Alpha Group International, listed on the London Stock Exchange. And I'm going to be telling you a bit about Alpha. I like to use Quick FS for looking at stocks, and here is Alpha Group International and Quick FS. So market cap's 1.4 billion, price to earnings ratio currently 15, with EV to free cash flow of 12.6, and it's had very strong growth over the last 10 years, with the median, the 10-year CAGR on revenue being 47%. Although growth has slowed a bit recently, more to the 20% range. Let's look a little bit at the business model of Alpha International. We're going to look at 5 different areas for Alpha Group International. Firstly, we'll talk about the business itself, where it earns money and revenues, the profits it makes, and the performance over the last 5 years since 2020. Then we'll talk about the history since 2010 to 2025, key milestones there. The competitors to Alpha, potential moats and growth that it's experiencing, and then a potential takeover by Corpay, a US listed company who have made an undisclosed all-cash offer for Alpha. We'll talk a bit about that. And then finally an appraisal, the valuation that I've come to, and conclusions. So Alpha has 3 main divisions, 2 big ones and 1 very new and small one. One division is corporate, and corporate is selling foreign exchange, interest rate and commodity hedging products to corporations in the UK and Europe and other places as well. The next division is private markets, where they sell the same products but to private entities like fund managers, private equity and so on. And they also manage accounts and payments in different currencies for them and provide a fund finance facility for them, not lending them money, but facilitating the finance. And then the third division is a small software as a service division called Corpay, which was purchased very recently. Now I'm going to talk a bit more in detail about these different divisions. So firstly, the corporate division. So this is a very large market for FX, interest rate and commodity hedging for businesses, particularly FX and interest rates. It's a market of $200 billion globally. Alpha has 1/20% of that. So the typical customer they have is a $20 million to $2 billion revenue company. And in 2024, Alpha had revenues of £64 million. That's doubled since 2020. So a good growth since then. And they have an underlying profit of 26 million on that, plus 5 million profit because they hold client funds, and then the client funds earn interest. So most of the money comes from margins and on these different contracts that they have on FX, interest rates and commodity trades, and also payment fees, and a small amount from client balance interest. The average revenue per client is 70k, and they're growing revenues over time, and they're growing client numbers too. So the next division is private markets. This was established more recently and it's much faster growing. This is really the growth engine of Alpha. It quintupled in size, 5x since 2020. So the typical customer would be a GP or general partner of funds in the private sector. They need banking services for their special purpose vehicles that they manage. And they cover a variety of different asset classes, from venture capital, private equity, private debt, infrastructure, real estate, and funds of funds. So the underlying profit in 2024 was £18 million, plus they made another 80 million on interest and client funds. So interest and client funds is about 80% of the total profit of this division. Average revenue per client is £104,000. So moving forward to Corpay. Corpay is their software as a service company that was acquired in December 2023, so about a year and a half ago now. And that enables a company who has a treasury system, like an ERP system, but multiple bank accounts with different banks to manage all of those accounts through one particular portal. So they basically act as the interface between all the different banks and that company and integrate their bank accounts into their ERP system. There's a great potential growth opportunity here. They increased their revenue 70% from 2023 to 2024. Currently, they're operating at a loss, but they're looking to scale a business and move to profitability. Average revenue per client is £23,000. And there's cross-selling opportunities for other divisions. They're seeing the introductions to clients through Cobase, but then they're able to sell the other FX and other products to these clients from getting the initial relationship with Cobase. So some history and key milestones of Alpha. Alpha was founded in 2010 by Morgan Tilbrook. It was a currency risk management specialist focused on UK corporates. In 2017, they did an IPO on the alternative investment market in London, and they had a market cap of £65 million. And then in 2018, they launched that fast-growing division, which I mentioned, the private markets division. They opened an international office in Canada as well for the corporate division. They opened various other offices and also rebranded from Alpha FX in 2022 to Alpha Group International, reflecting the wider range of things they were doing other than just foreign exchange derivatives. And then in 2024, they did a premium listing and became a constituent of the FTSE 250. And then in 2025, the founder CEO, Morgan Tilbrook, handed over the reins to Clive Kahn, who was originally with the company since 2016 as chairman. So he's an experienced insider. So he's taken over this year as the CEO. So let's look at the group performance of Alpha. Revenues up over the last 5 years from 46 million in 2020 up to 136 million in 2024. Profit before tax has increased considerably. Now you can see in the profit before tax in the top right there that the grey component, the statutory profit, has increased a lot in 2023 and 24. That really reflects the increase in interest rates and the vastly greater interest on client funds that are being held. So Alpha holds over £1 billion worth of client funds and earns interest on that. And that's growing by about £100 million per half year, their client balances, and should continue to grow as well. They're also a net cash business. They have no net debt. It's a very cash generative business. So they've increased their net cash from 52 to 218 million in 5 years. Moving forward, looking at the quality of earnings. So Warren Buffett mentions that you should calculate owner earnings, which is basically what an owner could take out of the business. So he would take the net earnings and he would add back all of the non-cash expenses like depreciation, amortization, and so on, and any other non-cash charges, and deduct from that all the cash spending like CapEx, for example, and working capital movements. So if we look at the calculated graph here of owner earnings versus net profit, we can see whether the earnings that are being reported are good quality or not, and how they compare to owner earnings. So the difference between them is shown in the graph here. But one of the key things I wanted to mention is the net working capital movements. So over this last 5 years, Alpha Group has only put in £500,000 into the business to grow the business. So really the business does not require any working capital from the corporation to grow, because the clients are funding it through funding the working capital. So that means it's a very low CapEx type business. Alpha don't have any manufacturing operations, obviously. They just have offices. So the business really doesn't require any capital to grow, which means that all the capital is available to buy back shares, to distribute to shareholders. That's a very capital light business, so it's a good quality one. I'd like to talk then about competitors, moats and growth. So one of the main competitors for Alpha is banks. 80% of the Forex market is in banks. 20% is non-banks like specialist Forex brokers. So Alpha takes a slightly different philosophy to its other competitors, saying that nobody can predict the currency market. They do not attempt to predict the direction of the currency market. They don't publish any forecasts saying we think the pound is going to strengthen versus the dollar or whatever. Really, they just focus on selling their clients hedging products to hedge against currency risk. They also hedge their own exposure to currency, so they're not really exposed to fluctuations in currencies, which is very helpful recently over the last few months. And they also took a philosophy of giving their clients as simple as possible derivative products. They don't have individual customer revenue targets for their customers, which means that they're not trying to be the salespeople are incentivized to push products on customers that they don't want or need or will be more complex for their needs. And that should help customer retention. Something I haven't looked into specifically, but I think that'll build a good relationship of trust with their customers. That's certainly what they would say in their communications. So let's look at a couple of competitors. One direct competitor called Record Financial, listed in the UK, and one indirect competitor who do a whole lot of other things as well. So Record Financial are rated lower in terms of price to sales, higher in terms of price to cash flow. They don't have as good operating margins or return on invested capital, and a lot slower growth. StoneX, they do a whole lot of other stuff in addition to FX products, like trading services and currencies and spot markets and other things as well. They're a big, more slow-growing US company with very thin margins compared to Alpha, probably because of all the other things that they do. So one of the other competitors it's interesting to look at is a company called Argentex. Argentex was listed on the London Stock Exchange, and recently they basically collapsed and they had to be taken over by IFX Payments, and they paid £3 million for the company. So the share price went down, as you can see in the graph here, down to 2.46 pence per share. And the reason this happened was because they offered what's called 0-0 credit lines to their customers. So the 0-0 credit line means you have to put, if you want to take a position as a customer in a particular currency, then you have to put zero initial margin down and zero variation margin, which means that Argentex is on the hook if there's a sudden variation in the currency exchange rate. And so after President Trump started tweeting in April and about tariffs and so on, there were some sharp moves in currencies. And Argentex paid out £20 million over the course of 20 days to maintain the variation margin on its customers' positions, and basically ran out of money. And so they collapsed. And so Alpha, on the other hand, hedges its exposure and does not offer 0-0 credit lines. So you could see that if you're not careful about your risk management, then this could be a risky business. But Alpha is not doing that kind of thing. So now I'd like to talk a bit about growth. Here's some stats about Alpha on the left here, but also this is the 2022 to 23. We can see how the revenues changed. So you can see that the proportion of revenue and income here. So we get about 10% growth in the corporate division, and the alternative banking, which is the private markets division, about 18% growth. And you can see the breakdown of it there. So the revenue CAGR over 10 years is about 45%. In 2024, they grew 20%. I think 20% is more a reasonable estimate going forward, but still quite fast revenue growth there. So now we move on to Corpay and their potential takeover of Alpha. So on the 6th of May 2025, Corpay made an all-cash offer to Alpha. The amount of the offer was not disclosed to the public. And Alpha immediately rejected the offer and opened discussions with Corpay. The PUSU period is under the UK takeover code. Corpay has a specific amount of time that they have to make an offer or walk away for 6 months. And that period can be extended by mutual consent of both Alpha and Corpay. And it's been extended a couple of times, the last time from the 7th to the 24th of July. It's quite a short extension, so I imagine that they will either make an offer soon or walk away. Corpay is a $22 billion market cap payments company headquartered in Georgia in the USA. So here on the graph, you can see a couple of things. They've got an arrow here in early May when the initial Corpay offer was rejected. But as I mentioned, we also have the buy alerts sent to members when I purchased the stock originally. That was in the start of December 2024. And then top up, as soon as the offer was made, I doubled the holding in early May 2025 as well. So now the offer was made when the stock price was about 2,800 pence. Just as of today, we're at 3,400 pence. So it's gone up about 20%, which is not a huge amount considering the potential value of the takeover. That's undisclosed. So finally, appraisal and conclusions. So the owner earnings from the last 2 years were £88 million on average. And that's an owner earnings yield of 6% on the market cap of Alpha, the current market cap as of today. Growth rate in the underlying business is about 18% a year, averaged over those 2 years. So if we add together the owner earnings and the growth, that's a 24% potential annual return in the stock from the business. That's assuming that the PE multiple stays at the current 15 times. Obviously, we saw on the previous slide here that the price was about 2,800 pence before the offer was made. So if there's no takeover, the price could well drop 20% back to that pre-takeover discussion price. So that is a risk. I think there's a kind of a binary, short term, there's a binary outcome here. Either the offer is made and the stock price rises to the offer price, whatever that is, we don't know, or the offer is not made and Corpay walks away and it drops maybe 20%-ish to the other price. However, I would say that Alpha, valued at 15 times earnings for a business that doesn't require any capital to grow, isn't a very stretching valuation. And so I think if they walk away, I'll still be holding. So I'd like to make a disclosure that the Real Worth Stocks owns a position in Alpha. It's our single largest holding. And none of this has been investing advice, but I hope it's useful to you in this information. And don't forget to follow us on YouTube and follow our podcast, subscribe to that. And you can also find us on Substack by searching for realworthstocks.com or going to that. And we're on X at realworthstocks. So please follow us there too. Thank you for listening. And if anybody has any questions or feedback they want to give, please leave them in the comments below or get in touch through Substack or X. Thank you very much. Bye now.